All right, so today I wanted to make a video on a company I know I've made a video about before, I've talked about before, but I wanted to do an update because it has been a while. Long story short here, I am still buying this company, although I do think it's bordering on expensive where it's at right now. I will get into that in a little bit. First things first, if you get value out of the video, please like, subscribe, comment, and check out those links below. So getting right into it here, $11.3 billion market cap. They are in the industrial sector, pay about a 1% dividend yield, free cash flow yield just below 4%, earnings yield just below, or 4.6 roughly. They engages in the manufacture and sale of engineered components and customized technology solutions primarily for the transportation, industrial, and energy markets. Basically, they make parts and materials for the defense, general, industrial, medical, and energy markets. And I think that's a good area. I mean, that area is critical to the growth of a country, right? And especially such a large and critical country in the world, being America. They're basically right in between their 52-week high and 52-week low. It looks like they're actually in a pretty clear correction, basically, to start the year out. They're down, actually, they're only down about 2%. But, I mean, if you go back a year, I mean, from their high back in November, they're down quite significantly from there. They're down right around 12, 13%. They are still up nicely going back a year. If we go back about 5 years, it's actually up quite nicely from there. So very nice growth, at least as far as the share price goes. Let's get into the insights here. Profitability, they're okay. I mean, they're an industrial company. They're not going to have software-like profitability metrics. 34% growth margin, 17% operating margin, 14% net margin, 12% free cash flow. Those are all pretty good numbers. Nothing to be concerned about there. If we look at their growth, revenue is increasing, profits are increasing, operating income, net income, all of those are going up fairly nicely. A current ratio of 1.4, I'm happy with that. They are buying back shares, which is also good. Earnings and revenue are only supposed to be up slightly, 2.6 and about 5% respectively over the next year. Although I think that's mostly due to the the uncertain environment going forward here. They are considerably below their average PE, although they are considerably above their average price to free cash flow and price to sales. I'll get into what I think it's worth roughly very soon here. Let's check out the financials here. First things first, if we look at the revenue has gone up basically every single quarter going back about 4 years, which is very good to see. If we look at shares outstanding, have also gone down consistently over time. They're not buying back shares super aggressively, but they are buying back shares, which is very good. Earnings also is at an all-time high, up considerably, almost double going back to 5 years ago, so that's good. And I mean, back in 2021, they had earnings for the first 3 quarters of 2021 was less than $1 per share, and they're at 6.3 for the quarter ending 2024. So very good growth there. If we look at their metrics here, their profitability metrics, let's start with operating margin is at an all-time high, which is good to see. Net margin, basically an all-time high, if not very close to it. Free cash flow margin, similar story, not quite in an all-time high, but still very close to it, so that's also good to see. And then if we look at, return on invested capital, that's actually gone down over time a little bit, but 17% is still good. I'm not concerned at all about that. That's still strong. If we look at free cash flow per share, is at an all-time high. They were actually negative back in 2022 and 2021, so very good to see they have gotten past that. Revenue per share also at an all-time high. If we look at the dividend here, dividend is going up right around, over the 10-year, 12% per year. The last few years, it's about 10. They've also beat the S&P very easily over the last decade. Going back about 5 years, they've also beat the S&P. So this is a company that perennially beats the market, and I think if anything, they're doing it in a safer way. So I very much do like this company. I mean, a slowing economy might hurt them, but I mean, a slowing economy is going to hurt most companies. So I'm not overly concerned there. And again, I'm a long-term investor. I don't care if we see a recession this year. I mean, it's going to pass, and it'll only provide a better buying opportunity. Analysts, take that for what you will, are very bullish, actually, extremely bullish. I mean, the average price target's 27% above where it's currently at. Even the low is 20% above where it's currently at. So analysts are overwhelmingly bullish. So let's get into the valuation here, just to try to value this company, because I think that's the most important part here. So if we look at earnings, have grown just under 12% going back a decade. Free cash flow has grown 13% per year. Price to earnings, the average PE has actually been around 27. We're currently just under 22. If we look at revenue, has grown about just under 4%. If we go back let's go back about 5 years just to see the difference here. Earnings has actually grown faster. Free cash flow and operating cash flow have grown slower, but I mean, that most likely would be due to going negative back in 2021 and 2022. Revenue has also grown faster. So earnings and revenue have grown faster. Free cash flow and operating cash flow have grown slower. The average PE has also been 36. So it's actually traded at a premium over the last 5 years. So let's get into the valuation, because I think this is, at the end of the day, the most important thing. So I'm projecting they're going to grow earnings at 9% per year, which is less than the roughly 11 that it's done over the last 10 years. I'm projecting them to buy back 1% of shares, which is pretty much exactly what they've done historically. Dividends going to grow 9% per year, which, I mean, if we look at the dividend here, the payout ratio is still 22%. So I think I don't see how they wouldn't be able to grow the dividend 10% a year unless they decide against it. But they're definitely not going to be able to grow it that fast due to any earnings, at least from what I can tell. And then I'm going to assume they traded at 20 PE, which is less than their 10-year and their 5-year average. That assumes we're almost exactly fair value. I am recording this before the video comes out, a handful of days before it comes out. So the share price, if it has a very big price movement soon, obviously I could throw this off a little bit. But where we stand right now, the current share price is right around 138. My discounted cash flow projects it to be around 137, 136. So, in other words, it's basically exactly fair value where it's at right now. If I wanted to take a position, what I would do is simply wait for a small pullback. That's what I would do. I already have a position. I'm basically going to set a price target at, let's say, 135 or 130. When it hits that, that's when I start buying. I'll check it maybe once a quarter and update it appropriately. If it stays above that, great. Because again, earnings projections can change, earnings growth can change, prices can change. So those are your price targets. You want to be updating every quarter. Maybe if you don't have that time, at least once a year, twice a year. But ideally, you're doing it every quarter. So that's basically what I'm getting at here. I mean, I really like these kind of companies. These are bread and butter companies that if the American economy is going to grow, they need companies like this. They're fairly well diversified. It's not like they have all their eggs in one basket. This is what's required to grow the economy, to grow the country. So I very much do like them. I don't expect crazy growth. I don't expect 15, 20% returns per year. They have beat the S&P though. I mean, I did point that out. They have beat the S&P over the last 10 years and the last 5 years. So this is a company that probably you will beat the S&P if you buy it and hold it long term. I think that they're that good of a company. But I don't expect, your 15 or 20, 25% returns per year. I mean, you realistically, you shouldn't expect that with virtually any company. But definitely not a company like this, that the growth is going to be a little slower and a little more pronounced than, a software company. And I'm okay with that, because at the end of the day, I think that the likelihood that a company like this is going to grow 10% per year over the next decade is more likely than your average, tech company. So that's my thought process there. So anyway, that's what I wanted to bring up today. If you liked the video, you got value, please like, subscribe, check out those links below, and stay tuned for more.